Hello and welcome. This lecture video is the final lecture video for Chapter 5, and it begins on page 113 of your course pack. And so we're going to be tackling this problem, okay? It says, following is the year-end adjusted trial balance for our sporting goods company, okay? So we have cash at $47,500 debit, accounts receivable $46,000 debit, merchandise inventory $50,000 debit, office supplies $800 debit, accounts payable $16,000 credit, salaries payable $850 credit, capital account $125,630 credit, withdrawals of $25,000 debit, sales of $500,000 credit, sales returns and allowances $4,500, sales discounts of $4,250, cost of goods sold $382,450, sales salaries expense $44,000, advertising expense $81,550, office salaries expense $24,325, office supplies expense $450, and then interest expense $5,055. And those, starting from our sales returns and allowances down to interest expense, those are all debits, okay? So what we need to do is prepare the closing journal entries, all right? So we look back at page 106 of your course pack. We had that those examples of our closing journal entries. So I want you to look at page 106 of your course pack and go back to that lecture video, or look in your notes, your completed notes, and use this as a template. Okay, use this as a template to do the closing journal entries for this problem. Okay, and I want you to pause the lecture video and then give that a try. All right, so the first one, for example, that you would do, we have the sales $500,000, right? We would debit sales and credit income summary for $500,000. And then all these sales returns all the way down to interest expense, you'd add up all these, debit income summary for the total, and then credit each one of these accounts. Okay, so, and then you follow it from there, okay? I don't want to give too much away, so I'll stop there, pause the lecture video, and then give it a try. Okay? Okay, hello and welcome back. So let's take a look at the journal entries. So the first one is debit sales, $500,000, credit income summary, $500,000. That's to close out the sales account, zero out the sales account. That's what I was saying just a minute ago. The next one is to add up the sales returns, sales discounts, cost of goods sold, sales expense, advertising expense, salaries expense, office supplies expense, and interest expense, and you get $473,180. You will debit income summary for $473,180, which is the sum of all those, just like what we did on page 106, exactly like that, just different dollar amounts. And then you credit. So the journal entry is debit to income summary $473,180, credit sales returns and allowance $4,500 to zero out the balance in sales returns and allowances, credit sales discounts for $4,250, credit cost goods sold $382,450, credit sales salaries expense $44,000, credit advertising $81,550, credit office salaries $24,325, credit office supplies expense $450, credit interest expense $5,055. Okay, then you have to do a T account, or I just like to do a T account. It's just the way I like to do it. It's the way I roll. So I have my income summary over here, my $500,000 on the credit side, my $473,180 on the debit side. I take my credits minus my debits, $26,820. This is net income. This is net income. So I have to move the balance in income summary. I have to zero out income summary and move that balance to capital using a journal entry. How do I do that? Well, I put a debit for $26,820 to the income summary. So I debit income summary $26,820. And then I credit capital for $26,820. That's my third journal entry. Then my last journal entry is to close out the withdrawals account and the adjusted trial balance. We had withdrawals of $25,000. So it's a debit to capital, credit to withdrawals of $25,000, exactly like what we did back in chapter 4, okay? So in the final page of your chapter 5 notes, just some quick comments on the periodic inventory accounting system. Remember, what we would do with our periodic inventory accounting system is that we would do an end of period count. Say, here's all of our inventory. Here's the value of our inventory. And then what we would say is, okay, does that then we could, I'm sorry, let me back up. So here's the value of all of our ending inventory, and then we would subtract that from our merchandise available for sale, and then that would give us our cost of goods sold. So at the end of the accounting period, we would debit cost of goods sold and credit merchandise inventory after we do our end of period inventory account. Okay. And so as I say right over here, during the accounting period though, because it's not perpetually updated all the time, merchandise inventory balance remains unchanged unless we purchase merchandise inventory. But when we make a sale, we don't debit cost of goods sold and credit merchandise inventory. We debit cost of goods sold and credit merchandise inventory at the end of the accounting period after we do our end of period inventory account. Okay. So we keep track of our merchandise inventory in our purchases account. And again, as I was saying, at the end of the period, we take a physical count of our inventory and then we subtract that from our merchandise available for sale to give us our cost of goods sold. Okay. So that's my quick comments on periodic inventory accounting systems. There will be no problems on your exams, on any exam on periodic inventory accounting systems, but I do want you to understand the basic concept of a periodic inventory accounting system. Okay. All right. Well, that concludes our chapter 5. Thanks so much.